Global events don't stay local for very long. When countries struggle politically or economically, financial markets usually react, sometimes immediately, sometimes slowly. In this video, I want to explain what global unrest means for the stock market, using Venezuela and the United States as two very different examples. Not politics, not opinions, just how markets respond to uncertainty. Let's start with one simple idea. Markets don't like uncertainty. They don't need bad news to fall. They only need unclear news. When investors don't know what will happen next, they become cautious. And when caution increases, money moves. Venezuela is an extreme example of what happens when trust in a system disappears. Over time, political instability, inflation, and loss of confidence caused the local currency to collapse. Savings lost value. Businesses struggled to survive. And local financial markets became almost irrelevant. For investors, this created one clear reaction: capital flight. Money left the country in search of stability. This shows an important lesson for markets. When trust disappears, markets don't slowly adjust. They break. Now let's look at the United States, which is a completely different situation. The US is still the world's largest financial market and the backbone of the global economy. But that doesn't mean it's immune to uncertainty. Political polarization, rising government debt, interest rate decisions, and election cycles all influence investor expectations. Unlike Venezuela, the US isn't facing collapse. But even small changes in confidence can move global markets, because so much of the world's capital flows through the US. When uncertainty rises in America, volatility increases everywhere. So what do markets actually react to? Not headlines, not emotions, but expectations. Markets constantly try to price in what might happen next. Changes in policy, leadership, or economic direction all affect those expectations. When expectations change, prices move. That's true for stocks, bonds, currencies, and even crypto. During periods of global unrest, investors often do a few predictable things. They reduce risk. They move away from uncertainty. They prefer assets that feel more stable. This can mean less exposure to risky stocks, more interest in defensive sectors, sometimes higher demand for cash, bonds, or gold. The key point is not what they buy, but why they buy it. So, what does this mean for the average investor? First, panic is rarely a good strategy. Markets have always lived through political tension, crises, and uncertainty. Second, diversification matters more during unstable periods. Relying on one country, one sector, or one idea increases risk. And third, long-term thinking beats reacting to headlines. Short-term news creates noise. Long-term fundamentals create results. Global unrest doesn't automatically mean markets will crash, but it does mean markets will become more sensitive. Understanding that sensitivity helps you stay calm when prices move. Because in investing, the biggest danger is usually not the crisis itself. It's how investors react to it. If this video helped you understand how global events influence financial markets, consider subscribing for more clear and honest investing explanations. My goal is not to predict the future, but to help you understand how markets actually work. Thanks for watching.